So 3 weeks of lower yields have been broken this past week, week over week. If you look at the change, yields have increased right across the maturities. Looking at money market yields from the 1 month out to the 6 month, July 8th set the year-to-date high on the yields, which is Friday. So on Friday they closed at the year-to-date highs. The jobs report was robust, it was good, and that is an indicator that the jobs market is very strong. The central bank has two mandates. Number one is full employment. Number two is price stability. Well, they've got more than enough full employment. So they got more than enough to play with there, but they don't have price stability. So that was a signal that the Fed is okay to go 75 basis points because the job market is so strong, because one of those check boxes are filled. Full employment, that's a done deal, good enough. So the curve moved in anticipation of another 75 basis point move going into the end of the month in 2.5 weeks. Raised all across the board. Let's look at something a little bit more critical here. Let's look at slope, and especially the 2 to the 10. We are now, we closed at an inversion. It was a drop of 7 basis points week over week, so it is inverted. However, 3 basis points for 1 day is not a big deal. That's not really going to change behavior. The reason an inverted yield curve is a predictor of a recession is because it changes behavior. It changes behaviors in credit markets, and that then flows through to investment and spending, which then, if you contract that, can cause the recession. So that's why we say that every recession is preceded by yield curve inversion, but not every yield curve inversion equals a recession, because a contraction in credit that changes investment and consumption may not actually cause a recession. It may cause a significant slowdown in growth, but may not cause a recession. It depends on how long the curve is inverted and how deeply it's inverted. So negative 3 basis points for 1 day is not enough to change behavior. You have to get this negative 20 to maybe negative 40 for 3 to 4 weeks to start changing behavior, which then may be enough to start the slowdown turning into a contraction. So this is something, we've entered into the inverted yield curve territory. How deep into this territory we go is something to watch over the next few weeks, but this just became an interesting point. It hasn't been that interesting up to now, but now it's interesting because these are red. If we look at the 3 month to the 5 year, 3 month to the 10 year, the 3 month to the 10 year has come in a little bit more. This is more towards bank profitability and their motivation to continue to provide credit. They're not governed too much by the 2 to the 10, but by the 3 month to the 10 year, 3 month to the 5 year. And they are lower, not so much on the 3 to the 5 year, 129 to 115, but 155 to 111. It is turning negative. The more negative these become, the smaller these numbers become, the less interested banks are in lending to anybody but the highest credit quality borrower available. So I've added a new chart down here for OAS because we have been looking at the at credit spreads. Here is investment grade and here is high yield, and I've also given some other ones, AA, triple B, and triple C or lower. This is the stuff you kind of want to stay away from. This breaks down into duration risk up here and credit risk down here. Duration is interest rate risk. So changes in interest rates change present values of any security that has cash flow. So the higher interest rates go, the lower bond prices go. For credit spreads, the wider credit spreads are, the lower the price. So you can have investment grade bonds and high yield bonds dropping in price without any interest rate changes at all because credit spreads are widening. The term to maturity, the typical term to maturity for investment grade is 10 years or more. For high yield, the majority of high yield is issued between having maturities of 7 to 10 years. So when we look at down here 1.6 and 5.5, these are spreads. These are not yields. These are spreads. To get yields, you have to add the spread on to the interest rate component, because this is just the amount you get paid for taking on default risk. The component that is default risk free, you still want to be paid for, because the thinking is, look, I can easily just buy a treasury. If I'm going to take on credit risk, how much more am I going to get paid? You're going to get paid this much more. So if we wanted to figure out what a yield on this was, we can look at a 7-year to a 10-year, 316 to 309. Let's cut it in the middle and call it 312 basis points added to the 550. You get 8.62. Roughly between 8.5% and 9% would be the yield on high yield. So when we say high yield bonds, these are not yields, these are spreads. I'm taking some time to explain that because on YouTube I saw two financial analysts who have a kind of a podcast, but it's also video and you can watch it on YouTube, talking about these and kept referring to them as the yield. The yield is now over 500 basis points. No. Got to be careful with the language here. The yield is not over 500 basis points. The spread is over 500 basis points. The yield is over 800 basis points. So it's a spread that we want to keep our eyes on. And last week I said you got to watch investment grade. Anything greater than 200 becomes a problem for high yield. Anything more than 800 becomes a problem. Every recession has had those two characteristics on investment grade and high yield, that investment grade was over 200, high yield was over 800, but just because it gets over those numbers doesn't mean it's a recession. It's like an inverted yield curve. Maybe it is, maybe it isn't, but every recession has had that. Well, look what we've had here over the past week. You've had interest rates going up, but you've had credit spreads reducing. Credit spreads are going to respond to the strength of the economy. Interest rates are going to respond to the projected path that the Fed is going to take. A strong jobs report, rates are going up. A strong jobs report means maybe a recession isn't in the cards, so credit spreads are going to tighten. Usually when economic outlook starts to look better, you'll get a bigger move inwards on high yield than you will on investment grade. So high yield is dropped by 42 basis points. If we look at the change in the 7s to the 10s, 24 to 21, interest rates increased, but spreads decreased, which means on Friday, high yield bonds rallied. So buying high yield bonds, you actually ended the day with a gain. Even though interest rates rose, it's just the credit spread contracted by more. That is very typical of high yield. High yield is very pro-cyclical, meaning as the economy improves, and interest rates go up, credit spreads contract more by than interest rates go up. High yield bonds tend to rally into expansions, whereas default-free government bonds tend to soften in price into an expansion, but rally in a contraction. High yield bonds will sell off in a contraction because their credit spread super widens. That's why we've been keeping our eye on the 800. AA, this is pretty much where banks sit. 98 basis points, July 5th. All of them hit their highest on July 5th. Ended the week at 92. Started the year at 62. It's at 92. This is, if we're thinking about how a bank would finance itself by selling long-term bonds, that's its cost of debt at the long end of the curve. Triple B, 200 basis points, started the year at 120. And triple C or lower, this is kind of where you don't want to be. 674 now 11.86, but I think that if we keep our eye on this over here, I think we're good for what we're trying to get done. Okay, real yields have all increased. Typically this is negative for equities and typically more negative for technology stocks. Especially unprofitable tech, because unprofitable tech has their cash flows way in the future. And you could make the argument that, well, if rates go up, because the inflation component went up but real yields stayed the same, it should not really affect companies that can pass through increases in pricing. But real yields are probably the best measure of the time value of money. That is truly the time of holding money, the cost of that time without any inflationary component. So the higher it is, the lower the present value of any real cash flows. So companies with cash flows way in the future get beat up even more. Didn't really see that going into the end of last week. Saw a lot of indecision on Thursday, saw a lot of indecision on Friday. However, I'm going to show you what the volume was like. It was suspiciously low. And we had trouble at 3,900, which is a resistance level on the S&P. And volume was just low. And it was low across all exchanges for Thursday and Friday. I'll show you the numbers on that. But up we go on real yields. Real yields here on the 30-year, July 8th. 102 year-to-date high, 102 on the 30-year, but we're not there yet. Still, June 14th is the high, year-to-date high on a lot of the nominal yields and for the real yields. Inflation expectations all creeped up, but just a little, 2, 3, 4 basis points. Nothing that raises eyebrows or says, whoa, what happened there? Not a lot. Didn't go up a lot because the thinking is, sure, the jobs report came in strong and wage inflation was good, but it's going to be met with a 75 basis point increase anyway, so it cancels each other out. So, neither up nor down on that one. It's kind of, I would say that this sounds to me psychologically like everyone's opinion is kind of unchanged on this one. Let's look at our mortgage market because the housing market is the most sensitive to interest rate changes, and it is a huge component in CPI. So if we can sort of predict or at least have some idea where we think housing prices are headed over the next few months, a big chunk of CPI is tied to rent and owner's equivalent rent. So let's see if we can make any sense of this. Mortgage applications for the week down 5.4%. Refis are down 7.68%. Purchases down 4.32%. And to put it in context, every week we look at refis and purchases, up or down this much percent, that much percent. Let's look at year to date. Refi index year to date is down 71.5% just from the beginning of the year. That means the amount of mortgage activity today for refinances is 29%, 28.5% of what it was on January 3rd. Purchase index down 18% year to date. If we look at the total mortgage market index, year to date is down 47.4%. That's a weighting between the refis and the purchases. Average mortgage size 405.2. This dotted line here is the end of April, beginning of May. So we can see over the course of May, June is in here somewhere, the average mortgage size has decreased. Up here, if we just draw this across here, we're somewhere around 455. We're down to 405.02. And this is to balance affordability. If interest rates or mortgage rates are going up, the purchase price, whatever you're willing to buy for a house, has to go down. So either housing prices go down or you don't buy the 2,500 square foot house, you buy the 1,900 square foot house and you lower the price of the house by the selection. Either way, we're down to 405.2. I've broken out the interest rates here. I've taken a different chart off of Realtor, not Realtor.com, but Mortgage News Daily. And I've set all of these to a $100,000 mortgage, so you can actually see the cost per week of a $100,000 mortgage. So you can think, well, if you had $1 million mortgage, you just multiply these by 10. 30-year fixed, 5.84. The 30-year FHA mortgage, 5.35. 15-year fixed is 504. 30-year jumbo, 485. This is, these two sort of like the benchmarks that you'd want to look at. This is interesting down here. Median listing prices. This is from Realtor.com, week ending July 2nd. year-over-year change. Median listing prices are up 18.3%. The week before, year-over-year, they were only up 15.7, and the week before that, year-over-year, they were up 16.9. You have this big jump. However, the commentary on this is that this is the week leading into the July 4th long weekend, which is a big weekend for open houses and buyers looking at different houses. So there's going to be a lot more demand on that weekend. So let's list at a higher price and we can accept a lower price. So this just might be a seasonal anomaly that is just reflecting the increased traffic that's going to happen over the weekend. Let's see what happens next week with this, but you need to see this come down. You need to see this the year-over-year change go to zero. If it goes to zero, that doesn't mean housing prices are falling. That just means they're no longer rising. And if they're no longer rising, then you have 0% component from housing in CPI. That's probably the best outcome that you could get, is that housing prices just go sideways from here. New listings up 8%. The week before they were up 5. The week before they were up 6. So new listings are increasing. Active listings, look at this, up 29% year over year from July 2nd. Last week they were up 25% year over year. The week before that they were up 21% year over year. So active listings are increasing. Inventory is increasing. And time on market, 2 days faster year over year. Last week it was 3 days faster. The week before it was 4 days faster. So the time on market is getting longer. Yes, it's selling 2 days faster on average than last year, but that is not the same as selling 4 days faster. It is taking 2 days longer. The average listing time is now 2 days longer than it was just 2 weeks ago. So that's moving in the right direction. So this is going in the right direction. This is going in the right direction. This is going in the right direction. This is all heading in the right direction. If we're looking at getting inflation down, these are all heading in the right direction. This may be just a Independence Day weekend anomaly. So we have a CPI report on Wednesday, and shelter, the weighting on shelter in the CPI is 32.437%. Roughly a third of inflation comes just from housing. Rent is 7.275%, that's the weighting, and owner's equivalent rent is 23.782. So a third of inflation from housing, if we can get that to flatline, or if the central bank with their interest rate hikes can get it to flatline, there's a third of it that disappears. Even better if you can get the housing market to print negative. Because it's a third, you don't have to worry about inflation in the other 2/3. If you can get this one to come down, this weighting with a negative number, with the other weighting with a positive number, is still enough to lower inflation. So your best hope for getting inflation down quickly without destroying the overall economy, but just by hurting a particular sector, it lies in housing. If we look at this chart here, this is from the National Association of Realtors Housing Affordability Index. They've been tracking it for some time. This is pre-pandemic. This is housing affordability. The higher it is, the more affordable it is. The lower it is, the less affordable it is. Look at this. All the way down to 102.5. I've got housing inventory here. Active listing count. In the U.S. We already saw that active listing counts have been increasing. In fact, from February 2022 to the most recent week ending, the active listing count has gone from 376 to 619. It's a 64%, almost a 65% increase in active listings over the last four and a half months. However, if we go back to June of 2019, this is June of 2022, your active listings were over 1 million. You're still down 53.3% from pre-pandemic levels from June 2019. However, it is promising that you're up 64.7%. This continues on, then you have a real possibility of having this multiplied by a weight of 0%, which a third of CPI would just disappear right there. or if you can even push this higher more aggressively with two increases of 75 basis points here in July, here in September. If you can get this to actually print negative 1%, think about the effect that that's going to have. That's disinflationary. That's a third of CPI would be disinflationary. Even if the other 2/3 are inflationary, that might be enough to offset. They might be able to pull it off with housing. I don't know. The problem with housing is the lack of supply. So trying to get rates to slow down or pricing to slow down, that's the big challenge. You might get it here. I don't know that you're going to get it here. If we go back here all the way to August 2016, this is just the beginning of the series. Look where this was in 2016, 1.549. And by June of 2019, basically 3 years, not even quite 3 years later, it went from 1,549,000 to 1,324,000. There were no stresses in the system at that time. Rates were super, super low. It's just that you had a period of underbuilding for so very long that the amount of family formation was greater than the amount of inventory that was available. So inventory was tight, so prices continued to increase. Well, all of this is just going to lead to more underbuilding. This right here is going to lead to more underbuilding. So once we get past this, housing's just going to show up again. And remember, it's a third of inflation. So you have to keep this down for a long period of time so that you can get the other 2/3 to come down before you remove any kind of restrictions, because you know that this is just going to, the housing prices is just going to respond to the lack of supply all over again. Let's see if we can't anticipate what the CPI, what the housing numbers in CPI are going to be. This is May 2021. This is the pricing index. This is May 2022. There's the pricing index. That is 5.216% higher year over year from May. If we look month over month, it is 0.596% higher. So the contribution to CPI from just rents. This is rents when we looked at the May report for CPI. The CPI report we're getting next week is for June. This is for May. The contribution of CPI year over year was 0.379%. That if these came in at zero, the core CPI would be 0.379 lower. Month over month, it added 0.043. The rents right now are, I shouldn't say rents, occupancy rates in apartment buildings have never been higher. They're somewhere around high 90s, which is pretty rare. Usually a good apartment building, a good one, will be somewhere between 91 and 93% full occupancy. An okay one, 82 to 85% occupancy. But to have across the board over 95% occupancy, that means rents are tight. And roughly about 30% of apartments roll over every year. 30% of them roll over, which means they're resetting year over year at higher rates. 30% of that building. So I don't anticipate any relaxation from rents as long as you have a housing market with a lack of supply and an affordability index this low. Just from, go back to 2019. Look at the difference from 2019. If you weren't able to buy a house here, you are not able to buy a house here. You're going to continue to rent. The rental market will be tight for some time, which means that as apartments turn over, most of these apartment buildings are professionally managed, rents are going up. Don't expect much relief here, but it only has a weighting of 7.25. This is the bigger weighting here. So the the job is on the housing price front. Let's look at year over year, May 21 to May 22, increase of 5.09%, and month over month was 0.5695. You can see that rents are just a little bit higher, but they're tracking very closely. Contribution to CPI year over year. If you can get housing prices to flatline, 1.211%, but you got to get past the year over year comparisons. If we're 15% or 18% price increase year over year, it's going to take, if you flatline, you got to flatline for 12 months to get year over year price increase to flatline as well. The month over month can start flatlining. In other words, you can get this to zero by just not having any price increase month over month, but it would take a year to wear that off. But if you can, there's 1.2% just from the housing market, but keeping the housing market on its back for 12 months, that's going to be a hard thing to do. Month over month, you could do it for a while, 0.13. We're concerned about headline being core being 0.6%. If you can get this to flatline, you drop this to 0.4646%. That's a nice big drop. That might be enough to ease the Fed back from 75, maybe down to 50, maybe down to 25 if you can actually get it negative month over month. Because look at the contribution, look at the weighting. And again, look at the contribution to CPI. So for June, the average home price hasn't really budged year over year, but month over month might be attractive. So this will be something to look at on the month over month, but I don't expect a lot of help year over year. But month over month may be interesting to see on Wednesday. Okay, I'm on Mortgage News Daily. I'm going to show you how to subscribe to a good Substack. I've been reading it for quite some time, and it's good, so I figured, well, you should know about it too, especially if you have an eye towards the housing market, whether it be the home builders or whether it be apartment REITs. If you scroll, this is the landing page, if you scroll down to Around the Web, they always have a link to Calculated Risk Blog because he writes good stuff. So just look down to see Calculated Risk Blog. Click on this one here, and you'll get just a synopsis. This is a brief excerpt of what he was writing. But down here it says you can subscribe down here. So if you click here, scroll down here, you type in your email address, you can subscribe, and you have all of the different stories that it has up. First look at local housing markets in June. Sales down sharply. He's on top of this. So rather than you doing all of the legwork and going to different sources yourself, starting with somebody who already does that is a good thing. But don't just take what he has to say. He'll give you a bunch of information, but that then gives you the source from where he got the information, so that you can then go to the source, and perhaps when you look at the data at the source, you may say, I don't agree with his assessment, or, oh yeah, he's right on there. This is apartment vacancy rates declined in Q2. And if that's what I said, if apartment vacancy rates are declining, that's how many how many units are available. If there are fewer and fewer units available, there is no reason for rents to go down. So I don't expect much give in the inflation numbers for the rent component, but owner's equivalent rent may give a little bit. And there's a lot of different articles down here if you want to look at what he has to say. But this is a good source. Just type in your email, hit subscribe, and this how the Substack works is it's not a platform thing where the platform alerts you to something. As soon as he publishes something, you get an email directly from him that it's been published. So it takes away that platform, and when it takes away the platform, it gives researchers, especially journalists as well, a lot more license to talk about subjects that maybe they couldn't talk about in other places. Okay, let's go through the minutes of the last meeting from June 14th to 15th. I've highlighted some paragraphs. And I want you to pay particular attention to their language in terms of their conviction towards inflation. This will give you a feeling that they are not going to stop until it's done. So let's just see what we have. And I've highlighted things all over the place, so we'll just scroll till we hit highlighting, and then we'll read some of this stuff. And I've also highlighted some stuff that makes reference to the available amount of treasury bills and the demand for reverse repos at the Fed window, because a lot has been written about this lately, that it has just increased dramatically, the use of the overnight reverse repo facility. And it's because when banks have extra money at night, they need to put it somewhere. Well, if the entire banking system is flush with money, then nobody wants to accept it. So what they do is they look for the least risky security to buy, which is typically a one-day T-bill. Well, there's no one-day T-bill, so you try to buy T-bills with the shortest amount of time because you don't want to take any price risk at all. You simply want the interest over that period of time. Well, there's a shortage of T-bills. So all of this money can't find a place to go. And if it doesn't find a place to go, it's got to invest somewhere. Well, that's going to push interest rates down, which is why the Fed steps in and says, whoa, 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 you cannot lend your money for less than this rate. If you're going to, we'll take it. And that's how the Fed pegs an interest rate. They will lend money at the higher end and they will borrow money at the lower end to make sure that overnight rate doesn't drop below their bottom target. While the banking system has got a whole bunch of cash. In fact, for a while, the banking system, some banks were talking with their corporate customers, trying to encourage them to put their money somewhere else. Please don't deposit your money here. Why don't you put it in some money market funds for a while? Why don't you put it over here or over there, but don't give it to us? Why would a bank do that? Is because there's something called a supplementary leverage ratio. Which the denominator are the assets. They're not risk-weighted anymore, they're just assets. For any risk-weighted asset, cash and treasuries have a zero weight. So who cares? Who cares? Give me all the cash you want. But there's another backstop ratio in the US called the supplementary leverage ratio that just says we're not going to risk-weight your assets at all. And you have to have equity. If you're a large bank, you have to have equity equal to 5% of your total assets. Never mind risk weighting. So when a bank gets cash, it's like, damn it, my total assets just went up because yes, they have a liability, but now they have cash, which is an asset. So their assets went up, and if it goes up too much, they got to raise their equity. So the best way to get equity is to get zero risk income. Well, you need T-bills to get that done. Because if you have zero risk income, you have pure margin. So if I make $1 with zero risk, $1 goes right to my net income, that goes right to my retained earnings, and I get equity. Well, where are you going to get that money, right? So the only way to get that done is with a guaranteed rate, and that's what the Fed has been doing. So let's pay attention to what's going on here. The federal funds rate held steady at 83 basis points throughout the period. This is prior to the rate increasing, right? This is the last meeting in June. While the secured overnight financing rate softened on net, falling to the bottom of the federal funds target range later in the period. Contacts attributed the downward pressure on secured rates to high liquidity levels, that means a lot of money in the banking system, and declining treasury bill supply. A lot of money in the banking system and no place to put it. Yes, everyone's trying to get those treasuries, but you can't buy a 1-year treasury or a 5-year treasury for one day, because what if rates change overnight and the next day you have a loss? You can't have that because you need equity to build, not equity to decrease. You need a guaranteed payoff. Well, a reverse repo is a guaranteed payoff by the Fed. So declining treasury bill as well as elevated uncertainty about the interest rate path. There is why they're not stepping out on duration, any kind of duration, because they have uncertainty about the interest rate path, which has increased demand for short-term investments. The shorter, the better. In fact, if there was such a thing as a one-day treasury, you wouldn't need the Fed window. All the banks would just buy one-day treasuries. That's guaranteed. In this environment, participation in the overnight reverse purchase agreement facility increased, and a greater share of activity in overnight private purchase agreement markets was conducted by lenders who lacked access to the facility. Not every bank can go to the Fed and say, hey, I'm going to give you some money, you give me your securities, and then you buy them back from me tomorrow at a higher rate. Not everybody can do that, so there is a private market for that. The manager noted that if the reverse repo usage continued to rise, it may be appropriate at some point to consider further lifting the per counterparty limit. Right now, the per counterparty limit is 160 billion. So if a huge bank like JP Morgan has 180 billion in cash, well, it has a limit of 160 billion that it can engage in this market for. And it's saying if liquidity levels continue to rise, if more cash builds up in the banking system, we're going to have to do something here. Otherwise, it's going to get hard to maintain that bottom range of our target, our overnight target, because money's going to find a home. These banks will find some way to do something, but money will find a home, so we better deal with it here. Over the longer term, reverse repo usage was expected to fall with the reduction in the size of the Federal Reserve's balance sheet, resulting in a gradual rise in money market rates relative to the repo rate. In other words, what they're saying is that if we stop being so bloody greedy by buying up all the treasury bills that are out there, then great. The banks will then have some of their own. What complicates the matter even more is tax revenues in the U.S. right now are really high because wages have increased, and when wages increase, your taxes, the amount of tax taken off your check, that amount increases even if tax rates do not go up, the amount of tax you pay increases. So because of the gains in wages, tax revenues are super high, leading to a decreased need to issue short-term T-bills. Well, that's a decrease of supply going on the market. You have a Fed that's sitting on a whole bunch of supply, and banks saying, come on, this is not fair. Like, what are we supposed to do? So the bank says, you come over here, we'll take care of it. And they expect it to decrease as their balance sheet runs off. So if you've been hearing about the reverse repo and, oh my God, is this a sign of trouble? No, it's not. It says right here, high liquidity levels, that means lots of cash in the banking system, declining T-bill supply, no place to put it, and elevated uncertainty about the interest rate path, certainly not going to take on duration. Take those three things together and the Fed's got to say, okay, we've been greedy, we'll share it with you. All right, let's keep going here. Supply disruptions appear to have improved in some sectors, such as general merchandise, retailers, and we've seen that with Target, we've seen that with Walmart. They have way too much inventory of things. They're clearing these things out. In fact, a bunch of retailers have been saying the same thing, that all this inventory is landing all at one time, and consumer demand is shifting away from goods to services. What are we going to do with this stuff? So, but have deteriorated in others, such as materials for home construction. The big one there is windows. You can't get windows. My contractor was here the other day who did the back of my house, the addition onto my house. I said I couldn't get these sliding doors for my patio, and so we just canceled the whole thing. I asked him, any news on the doors? Should we order doors now? He just shook his head. He says, no, we have other jobs where we can't get windows. So forget your sliding doors for a couple of years. A couple of years. Really, you got to get in line just to order a window. Anyways, have deteriorated in other areas such as materials for home construction. Well, what's that going to do? That means, I've shown a couple of weeks ago that big backlog of homes under construction, like 1.6 million homes under construction. Well, if you can't get materials, that's still going to be locked up supply. So I don't know how we get prices to contract year over year by enough to get that housing component, the owner's equivalent rent component in CPI to help out. When you see things like this, what you want is this to clear up so that a whole bunch of supply hits the market all very quickly and pushes prices down enough so that you can actually get a 10% or 20% drop in housing prices back to where they were last year. Then year over year you can get 0% in 2 months if you can get housing prices to drop. This does not look good or sound good for potential major corrections in housing prices. The credit quality of firms, municipalities, and households remain largely stable. That's good. Although the outlook for credit quality has begun to deteriorate somewhat. And we saw that when we look at the OASs from the beginning of the year to now, especially in high yield, we're over 500 basis points. Over 800 is a red line. That's where we, start to clutch our pearls and, bite our nails a bit. What do we have here? Secured overnight rates softened significantly relative to the reverse repo offering rate since the May FOMC meeting, with downward pressure on rates attributed to continuing declines in net treasury bill issuance, elevated demand for collateral in the form of treasury securities, and money market funds maintaining very short portfolio maturities amid uncertainty about the pace of anticipated policy rates. Let's talk about this here. What's going on there? Money market funds invest in securities with maturity a year or less. They're pure discount securities. One of the rules, I don't know so much if it's a rule, is that they cannot break the buck. Meaning that if somebody puts $1 into a money market fund, it cannot at some point be worth 99 cents. They can't break the buck. When interest rates are stable, when the central bank telegraphs that interest rates are going to be stable for an extended period of time, they can take 6-month and 1-year money market securities, even though there's duration risk in there. The thinking is, well, rates are going to be stable for a long period of time. So if we have a weighting of even 8% or 9% on the 1 year, it's not, we're not going to break the buck here. It's going to be okay. So they can reach for a little bit more yield out of the 1 year if they expect it to be stable. But we don't have that right now. The 1 year has moved dramatically since the beginning of the year. So money market funds are saying, we can't break the buck. We can't get near the 1 year. We got to move as close to the 30-day as possible. Well, they're moving towards the 30-day. All banks want to move towards the 30-day. The Fed's sitting on a whole bunch of that stuff. Something has to give. You have the Treasury with tax receipts coming in that are extremely high right now because the source deduction for wages is extremely high. They don't need to issue that many 30s. So again, you have a bit of a supply problem in the T-bill market where you have this large demand because of interest rate risk with lower supply. So yeah, the Fed has to step in with the overnight reverse repos. Treasury securities and money market funds maintaining very short maturities. Consistent with the downward pressure on repo rates, daily uptake in the reverse repo facility increased further. Yeah, it would have to, right? Outflows from emerging market dedicated funds intensified in early May. This is going to be something I'm going to start adding next week, is an emerging market watch, because we had problems. Well, Sri Lanka has been a problem. Overthrew the government, basically. They're going to resign, and that's it. Sri Lanka, I don't know so much that it's canary in a coal mine for emerging markets, because a lot of Sri Lanka was just mismanagement. Some very bad decisions about, no more fertilizer, banning fertilizer for use in Sri Lanka because the government wanted to be seen as leading the green revolution and being environmentally friendly, without realizing that it was going to cut harvests in half. So now you got to import food. Well, guess what? You need US dollars to do that. And after the terrorist attack that happened in Sri Lanka, where something like over 200 people got killed, tourism dropped. So their supply of US dollars disappeared. Once you run out of US dollars, you're not importing food. You're not importing anything because you need US dollars. So a lot of Sri Lanka was mismanagement. But we are going to start looking at emerging markets because of their external debt, especially markets that have a significant amount, up to 30% of their debt, that's external debt denominated in a currency other than their own, with the biggest one being the US dollar. With King Dollar right now, it's becoming harder and harder for those countries to meet their payment requirements. So we're going to start adding that. Outflows from emerging market dedicated funds intensified in May. That's an early warning sign, especially from local currency bond funds. And credit spreads in emerging market economies widened moderately. This is a problem because you can borrow money in your own currency, sell that to buy the foreign currency to pay off that debt, but look at what's going to happen. You're layering on more and more expensive debt. Either the dollar has to stop and go the other way, because if it continues on as king dollar, you will knock over some of these dominoes. Lots of good stuff in this report, huh? Residential mortgage credit remained widely available through May for most borrowers, while refinance volumes continued trending lower in April and May amid higher mortgage rates. Outstanding balances of home equity lines of credit at commercial banks posted the first significant increase in more than a decade, likely reflecting a substitution by homeowners away from cash-out refinances. Okay, let's figure out what that means. What is a cash-out refinance? Let's say you buy a home at $500,000 and 2 years later it's $750,000 and interest rates are a little bit lower. So you go to the bank and you say, I would like to refinance my house and I would like to take out $100,000. That's called a cash out, where you refinance at a lower rate but at a higher amount than what you already owed, and you pull money out of your house, you take that $100,000 and you load up with an SUV and a boat in the driveway. In other words, you're using your house as an ATM. Well, with interest rates going up, the refi market has dropped. So what they're saying here is, or what they've noticed here is, outstanding balances of home equity lines of credit have increased, likely reflecting a substitution by homeowners away from cash-out refinances. So they're still using their homes as an ATM. They're just not using a cash-out refi for it. They're just loading up on their home equity lines of credit. In consumer credit markets, auto loans outstanding grew at a robust pace in the first quarter, consistent with a rebound in auto sales, but slowed in April and May. Credit card balances at commercial banks rose in April at the fastest pace seen in recent decades, but growth slowed in May. Now, it doesn't say it retreated. Growth slowed in May. Still grew, but slowed. We got a report last week on consumer credit, late on Friday. If you had checked out early, you missed it altogether, but we'll have a look at what happened to consumer credit on Friday. It dropped significantly, so it slowed yet again. Let's keep going. Banks allocated net positive loan loss provisions in the first quarter of this year. This development reversed a pattern of loan loss reserves being released throughout last year and reflected concerns about the credit quality outlooks. Next week, large number of banks, I think it's up basically next week is a banking theme. Banks are reporting earnings next week. One of the things, and I'll talk about it on the screen coming up, one of the things that we're going to pay attention to if you're interested in the banking sector is what are they going to do with loan loss provisions this quarter? Are they going to increase it, leave it the same, or decrease it? And it's going to be suspect if a bank, to make earnings, decreases its loan loss provisions. That's going to be very suspect. I expect that you're going to see loan loss provisions increase, which is going to weigh on bank earnings. Where are we here? The staff continued to judge that the risks to the baseline projection for real activity were skewed to the downside, and that the risks to inflation projection were skewed to the upside. And what they're saying is that we think growth will be A and inflation will be B. However, we do believe that growth has the very real possibility of being less than A, and inflation has the very real possibility of being greater than B. That's what we mean by it's skewed to the downside, skewed to the upside. The staff judged that the ongoing war in Ukraine remained a possible source of ever greater upward pressure on energy and commodity prices. Upward pressure on energy, bad for Europe. Upward pressure on commodity prices, bad for countries like Japan, and especially emerging markets that import most of their raw materials. While the war and adverse developments associated with China's zero COVID policy were both perceived as increasing the risk that supply chain disruptions and production constraints would be further exacerbated in the United States and abroad, this is a problem because it's not gone. It's not gone, and these new variants, BA4, BA5, are apparently, each variant on Omicron appears to be more and more contagious. Less lethal, which is good, but more and more contagious. They got a zero COVID policy. They don't say they have a zero Omicron policy or Omicron BA2 policy, but it's okay for BA4 or BA5. It's zero COVID policy. the possibility that they're going to shut down again is very real. They will shut down again. If they shut down again, it's actually going to be beneficial for oil prices. It'll be beneficial for energy, because energy prices will drop, because no one's driving in that city when they lock it down, depending on how many cities they lock down. But I think it would be irresponsible as an investor in any company that has significant China exposure to imagine that it's over, that they're not going to shut down again. They will continue this policy. All right, let's see what else we have here. Growth in business fixed investment appeared to be slowing. Now, if you have slowing fixed investment, your current period investment is tomorrow's growth. So keep that in mind. Activity in the housing sector appeared to be softening. Softening, but not weakening. Softening. An easing of supply bottlenecks, a further rise in labor force participation. Well, that was June 14th. The jobs report last week showed a drop in the participation rate, which just makes the labor market tighter. And the waning effects of pandemic-related fiscal policy support were cited as additional factors that could help reduce the supply-demand imbalances in the economy and therefore lower inflation over the next few years. Not few months, few years. What does this mean? Waning effects of pandemic-related fiscal policy support. That means people receiving money for staying at home. Not earning money, but getting money. People are not getting money anymore. Well, all that money that found its way into people's bank accounts, sometimes people were making more money being paid to stay home than they were making when they were working. So they went out and they did things like, well, I'm going to go buy a truck, I'm going to go buy a car, I'm going to spend money on this, I'm going to do that. So that created to the excess demand. Well, that's disappearing. What they're saying is we shouldn't expect to see that source of demand anymore. Participants saw little evidence to date of substantial improvements in supply constraints. Well, that's not good, right? Some of them judged that the economic effects of these constraints were likely to persist longer than they had previously anticipated. It's not good that you're going to have supply constraints persisting longer. But what I find at least a little bit enlightening here is that they recognize that there are things that the interest rate is not going to fix. Household sector. Participants indicated that consumption spending had remained robust, in part reflecting strong balance sheets in the household sector and a tight labor market. Several participants noted that household spending patterns appeared to be shifting away from goods to services. Several participants indicated that some of their contacts reported that the pace of consumer spending, though strong, was beginning to moderate. Business sector. Participants observed that their contacts generally reported that sales remained strong, although some contacts indicated that sales had begun to slow and they had become less optimistic about the outlook. In many industries, the ability of firms to meet demand continued to be limited by labor shortages and supply chain bottlenecks. Firms relying on international sources for their inputs were seen as encountering particularly acute supply chain disruptions. Supply constraints, labor shortages, rising input costs were also reportedly limiting energy and agricultural producers' ability to take advantage of the higher prices of their products by investing and expanding their production capacity. Similarly, a few participants noted that in other sectors of the economy, their contacts reported that they were postponing investment or construction projects because of rising input and financing costs. With supply challenges still widespread, contacts continued to assess that supply constraints overall were significant, and many of them judged that these constraints were likely to persist for some time. So there's some good stuff in here. That we already knew. We already knew there were supply constraints. We already knew there was a labor shortage. We'll look at the JOLTS report again, and the JOLTS report again, job openings over 11 million, quits rate over 4 million. There's still almost 2 jobs for every individual out there. Mind you, it's backwards looking. It's May data, but still, it's there, right? The lack of investment. You have some contacts saying, look, with the price of everything right now, we're not investing or expanding our production capacity. Well, look what's going on. If you're not investing and expanding your production capacity to take advantage of the high prices, how are you going to solve the high prices? So interest rates have to go up, which then increases the cost of expanding my capacity, so I don't do it even longer, thereby keeping the amount of supply constrained for a longer period. This is a vicious cycle. Demand for labor continued to outstrip available supply across many parts of the economy. I don't know that that is going to fix itself anytime soon. You have more people retiring per day in the US than you have entering the labor force. You have about 10,000 boomers retiring every single day. Every single day. Over the course of the year, you're going to have some 3.6 million people leave the labor force because they're retiring. But you don't have 3.6 million people entering the labor force. And the US, I shouldn't single out the US for this. It's a lot of countries around the world. A lot of the developed countries around the world have turned anti-immigrant. Some have been anti-immigrant for decades. And over the past 10 years, more and more countries have turned anti-immigrant. So if you're not going to get growth through your population and you're not going to get it through immigration, your participation rates are going to continue to decline. And if you're going to try to onshore global production lines, where are you going to get the labor from? At some point, technology is going to have to step in, but technology can only do so much. There are some jobs where you simply can't have a robot replace it. Housing construction is one of those things where you need people. So I think a theme for the next generation, the next decade, the next bull market run, I think a big theme is going to be in automation. A lot going on in automation because you don't have the participation rate, you don't have the workforce to get it done. That's kind of something to watch. Most business contacts had continued to report persistent wage pressure as well as difficulties in hiring and retaining workers. However, some contacts reported that because of previous wage hikes, hiring and retention had improved and pressure for additional wage increases appeared to be receding. Well, that's good. Again, if you can get that to flatline for a couple of years, well, let's just be clear. It's not going to flatline for a couple of years, but if you can get it back to its original growth rate of maybe 2 to 3% per year instead of the 5 to 6% that it is now, that can go a long way. However, I've said this before. I think this is a great opportunity to fix wealth and income inequality. If we look at who is getting the raises, and we'll look at the jobs report next, it's not management that's getting the bigger raises, it's the lowest income earners getting the biggest raises. In fact, they are outperforming inflation. The top 20% in terms of wage increases, I shouldn't say top 20, let's say top 50% in terms of wage increases are underperforming inflation. The bottom 50% are now outperforming inflation. Every day this persists, you're fixing income inequality. So I'm not too concerned about that, because if you have a healthy base, you will have a healthy economy. And, well, let's say that we can live with 3% inflation instead of 2. 2 is rather arbitrary to begin with. Why not make it an arbitrary 3%? All right. Labor force participation remained below its pre-pandemic level because of the unusually large number of retirements during the pandemic, and judged that the labor force participation rate was unlikely to move up considerably in the near term. Well, we've been saying that for a couple of months now, right? A couple of participants raised the possibility that tight labor markets would spur investment in automation by firms, boosting labor productivity. Well, firms are going to have to. It's called induced innovation. You can innovate to seek growth, or you can innovate to survive. And innovating to survive is something called induced innovation, where you have no choice, innovate or die. If you can't get the labor, you're going to turn to automation. Inflation remained much too high. I highlighted that because it didn't say inflation remained elevated. It used to say inflation remained elevated. Much too high. Look at the language. Much too high. If you're saying, oh, that's way too much, well, then in your mind, you have something significantly lower. If you say, that's too much, maybe you have something a little lower. But if you say, that's way too much, well, not way, but much too high. Okay, while measures of longer-term inflation expectations derived from surveys of households, professional forecasters, and market participants were generally judged to be broadly consistent with the committee's longer-run 2% inflation objective, many participants raised the concern that longer-run inflation expectations could be beginning to drift up to levels inconsistent with the 2% objective. These participants noted that, and this is a dangerous line, if inflation expectations were to become unanchored, it would be more costly to bring inflation back down to the committee's objectives. What is this saying? It's saying, look, if this happens, it's going to be brutally hard to get it back down, which means we're looking at really big rates. It's going to be more costly in terms of economic growth, in terms of employment. So let's err on the side of caution now and let's just raise rates. Heck, let's go 100 basis points. Let's front end load it and get it done because we don't want to pay that price. We want to get inflation expectations down dramatically. Now, since the June 14th meeting, we've seen over the last 3 weeks, inflation expectations that are built into when we look at the difference between the nominal and the real rates and we look at the 5-year forward, they've all come down. So maybe this concern has also come down as well. But the fact that they're saying it would be more costly to bring it down if we don't do it now, that kind of tells me something. This language here, much too high, more costly to bring it down. I put those two together. I say, oh, this is, they're not going 25. Forget that. That's off the table. In their consideration of the appropriate stance of monetary policy, we're almost done here. Participants concurred that the labor market was very tight. Inflation was well above the committee's 2% inflation objective, and the near-term inflation outlook had deteriorated since the May meeting. Against this backdrop, almost all participants agreed that it was appropriate to raise the target range for the federal funds rate 75 basis points. One participant favored a 50 basis point increase in the target range at this meeting instead of 75. And this participant agreed with 75 but said we should go 50 because we have not communicated 75. We've communicated everything and we've done everything we've communicated. This is outside of our communication. So that's why they want to go 50 purely to be consistent with their communication. And it was only one that wanted to do it. They went to 75. In light of elevated inflation pressures and signs of deterioration in some measures of inflation expectations, all participants reaffirmed their strong commitment to returning inflation to the committee's 2% objective. Participants observed that a return of inflation to 2% objective was necessary for creating conditions conducive to a sustainably strong labor market over time. The language tells me that they have their eye on 2%, and that's it. And they're going to keep going until they see that they're going to be back at 2%. In discussing potential policy actions at upcoming meetings, participants continue to anticipate that ongoing increases in the target range for the federal funds rate would be appropriate to achieve the committee's objective. In other words, they're saying, yeah, we're not done. We're not done raising rates. We're going to raise them. But how much, right? In particular, participants judged that an increase of 50 or 75 would likely be appropriate at the next meeting. 25's off the table. You got 50 or 75. Given the jobs report we had last week, and we have CPI coming up on Wednesday. If that number prints hot, you can go 75. If it prints really hot, you might even go 100. Participants concurred that the economic outlook warranted moving to a restrictive stance of policy. That means getting the short-term rate or the overnight rate not to the neutral rate. That's neutral. Below the neutral rate is called accommodative. They're in accommodative territory right now because they believe they're below the neutral rate, which means get to a neutral rate, right around 2.5%, and then beyond that. That's restrictive. Warranted moving to a restrictive stance of policy. And they recognize the possibility that an even more restrictive stance could be appropriate if elevated inflation pressures were to persist. So Wednesday, and all eyes are going to be on Wednesday. Not only just Wednesday, we got a big week coming up. We got Wednesday CPI and we got earnings. You got two big things coming up, which could explain why volume going into last week, Thursday and Friday, just drifted off to nothing. Because why would you take on new positions ahead of two big giant pieces of information, right? At the current juncture, with inflation remaining well above the committee's objective, there again, the language, well above. They're making it very clear they don't like where it is. Participants remarked that moving to a restrictive stance of policy was required, not maybe, was required to meet the committee's legislative mandate to promote maximum employment and price stability. In addition, such a stance would be appropriate from a risk management perspective because it would put the committee in a better position to implement more restrictive policy if inflation came in higher than expected. Many participants judged that a significant risk now facing the committee was that elevated inflation could become entrenched if the public began to question the resolve of the committee to adjust the stance of policy as warranted. On this matter, participants stressed that appropriate firming of monetary policy together with clear and effective communication would be essential in restoring price stability. I get this far and I think they're going 75. Unless CPI really comes in like, 1% headline, 1.5% lower year over year than the last print, they're going 75. And I think that was it. Members judged that with high and widespread inflation pressures and some measures of longer-term inflation expectations moving up somewhat, it would be appropriate for the post-meeting statement to note that the committee was strongly committed to returning inflation to its 2% objective. And here is the part about the reverse repo. Conduct overnight reverse repurchase agreement operations at an offering rate of 1.55. So if you're a bank and you have extra cash, you give that cash to the Fed. The Fed gives you short rate security. Well, actually, they don't even have to give you short rate securities. That's a nice thing about a reverse repo, is that the Fed can give you a 10-year treasury because it's not the price risk that you've taken on anymore. It's an agreement. It's now just collateral. The very next day, the bank sells that 10-year treasury back at a guaranteed 1.55% return. That's 1.55% annualized. That's the easiest and most efficient way to add equity to the bank. To increase their equity position is to give them guaranteed income. And that's what is going on. They're getting guaranteed income. A 1.55% with a per counterparty limit of 160. Remember, they said it may be necessary to increase that per counterparty limit. 160 billion per day. The per counterparty limit can be temporarily increased at the discretion of the chair. And that's it. There is a lot of good stuff in here, right? Okay, the jobs report, Bureau of Labor Statistics. This was released Friday at 8:30. And we're not going to spend that much time on it. Just a few things to point out. First thing, average hourly earnings for all employees. We're going to break it down between all employees and production and non-supervisory. All employees on private non-farm payrolls rose by 10 cents or 0.3% to 32.08. Over the past 12 months, our average hourly earnings have increased by 5.1%. Private sector production and non-supervisory employees rose by 13 cents or 0.5%. So 0.3 for everyone, but if you strip out management, it increases to 0.5, which means management must have been less than the 0.3, right? And we'll scroll down to a number of the tables here. I want to point out some things. This is employment by selected industry. This is for June. Notice these are all positive, all increases except for one category, 9,000 down, and that is government. Well, that's what you want to see, right? You want to see that the government is spending less money, and they are. Down here we have index of aggregate weekly payrolls. 2007 was an index of 100. It is now at 172.4, meaning that since 2007, wage earners are earning 72% more than they did today than they did in 2007. And this is a diffusion index. Anything over 50 is growth. Total private and manufacturing, both of them have a diffusion index over 50, which means they're still growing their labor force. Not decreasing it as of course, June 2022. And I think here we have to scroll down quite a bit. And we're just going to look for the next bit of highlighting. I think it's down around page 30. And it is the change in average earnings. I think we get to overtime first, which is coming up. What page are we on now? Page 26. We got a ways to go, I think. Bear with me. We'll just keep scrolling. That's why I highlight these. This is neat to see. June 2022, and this is June 2021. This is average overtime hours. When labor forces are contracting, typically temporary workers go and overtime hours are the first to go before layoffs start happening. Well, look at last year. Manufacturing 3.2 hours overtime, 3.2. Durable goods were 3, non-durables were 3.4, durables are now 3.2, and this is 3.1. That is not going to zero, meaning that the amount of overtime hours are not decreasing. If they're not decreasing, that's still indicating a very tight labor market. All right, this is average hourly and weekly earnings of all employees, all on private non-farm payrolls by industry sector, seasonally adjusted. So here's how this breaks down. If we look at non-seasonally adjusted, and we just take non-supervisory workers and production workers, in other words, these are not management. Year over year, non-seasonally adjusted, they're up 5.4%. If you seasonally adjust it for seasonal variations, they're up 10.7% year over year versus inflation, which is somewhere around 8%. So the working class, and that's what I'll call them, as opposed, or you can call them blue collar as opposed to white collar. We'll use some older terminology to refer to these groups. They're outperforming inflation. And if they're outperforming inflation, I don't think their retail sales, I don't think their spending or their consumption is going to decrease. If we look at the management sector, non-seasonally adjusted 4.2%. Seasonally adjusted, well, we don't know what they are seasonally adjusted because they don't break them out. All employees seasonally adjusted are 9.4. Non-management are 10.7, which means management must be lower than 9.4 because that's the weighted average of everyone. So we can see that the wage increases are actually doing a lot right now to fix income inequality. So you can get this this is on page 34. Page 35 are indexes. This is all employees, so you can get June 22 over June 21 to get to the numbers that I got to. This is seasonally adjusted. You'll find that this is 10.7% higher. This is all employees. And if you scroll down here, where's the next one here? This is earnings of production and non-supervisory employees. So this is not all employees anymore. Management is now gone. And then you could look at the average weekly earnings. This is seasonally adjusted as well. You'll get 10.7%. And then there's another index down here. This is payrolls for production and non-supervisory employees. Again, on an index basis. This one up here was on a dollar basis. This one here is on an index basis. You'll get the same result. You'll get to 10.7%. Okay. All right, let's move into a look on energy, and then we'll have a brief discussion on food. Looked at housing. Housing makes up, or shelter I should say, makes up 32% of CPI. I don't think we're going to get much relief on Wednesday from rents. Owners equivalent rents year over year I don't think is going to help very much. Our best hope there is month over month improvements. Wage gains year over year I don't think are going to help very much. We might get some month over month improvement, but I doubt it. The JOLTS report showed 11 point some million openings, quits are still over 4 million. Which means there's still a lot of people who can quit their job, move to another job for more money. And we even saw that in the FOMC Minutes that some contacts of the Federal Reserve banks were reporting that it was hard to retain these people because they kept leaving for higher wages. So I don't think we're going to get much there. Are we going to get anything from energy? Let's have a look. First, somebody had asked me to talk about refining capacity globally, so I started the research on that, and I found a great report. So rather than me dive deep into the report, if you're interested in refining capacity globally, this is a really good report. Since the pandemic, the U.S. has lost 1.1 million barrels per day of refining capacity. They have 128 refiners. They had 135. Their capacity combined is 17.9 million barrels per day, and they're all running at higher than 90% utilization. So you really can't squeeze much more out. They're running 24 hours a day, 3 shifts running all day long. There's very little more that you can squeeze out. China had banned exports of finished products. They do have some export quotas. Because of the lockdown, they had a whole bunch of inventories build up. So they did say, okay, well, I guess we can export some of that stuff. So for 2022, their export quotas are 17.5 million tons versus 29.5 million tons for 2023. This is something you can look to China to do more and more of, which is export restrictions and export quotas. For refined products, I think if they can avoid the lockdowns, they'll go back to export restrictions. They may do that in some foodstuffs, and for certain raw materials, they've already introduced a no export policy for some raw materials in the EV battery supply chain. Graphite is a good example. No more exports. I would look to them to begin to do more and more of that. New global capacity is coming online by 2025. There are 416 upcoming refining projects around the world. 93 are new builds, 323 are expansions, and it breaks down like this. 220 are in the construction phase, with most of those being expansions. 83 are in the approval stage, 87 in the feasibility stage, with the majority of these being built. These may never exit the feasibility stage. This 416 will add 12.75 million barrels per day of refining capacity across 6 regions, and the regions break down here. The light green is a new build, the dark green is an expansion. Asia, by far the biggest. Most of the APAC countries, other than China, most of the APAC countries haven't really said much about what their end date for internal combustion engines are. Middle East, Africa, most of them are new builds. North America, this includes US, Canada, and Mexico. These are new, but again, most of those are in the feasibility stage. I don't know how feasible it is to build a refinery at this point. If all of this comes on by 2025, that represents a compounded annual growth rate of 2.6% in refining capacity. The current global usable capacity right now is about 82 to 83 million barrels per day. This takes certain countries off the market, like I think 30% of Russian capacity they've just eliminated. So this is down about 3.3 million barrels per day since 2020, and this includes Russia in this amount. And the projection is over the course of 2022 that new capacity coming online will add about 1 million barrels per day, and through 2023 will add about another 1.6 million barrels per day. Let's look at the report itself now. Okay, here is where you can find that report, and like anything that's detailed and deep, it's not going to be free. $3,000 for that. This is institutional buyers that would be buying this. This is where I got the summary from, and then from other sources that were able to quote some of this, I got some extra information. It gives you a table of contents so you can actually see what it is that you're going to get out of this. It gives you the scope and reasons to buy, right? There are some free sources. Let's go to the EIA, the U.S. Energy Information Administration. This is June 22. This is a 54-page report, short-term energy outlook and it sort of comes to the conclusion that you're going to have a tight market. It doesn't see prices going to $380 like I think JP Morgan had a scenario where it was going 280 or 380, and it's not going to 65 like Citigroup has a scenario that it's going to 65. It's got a fairly tight range, moderating over time down to 100 a barrel on average, which I think is probably a decent forecast. But it is detailed. There's a lot here, a lot of different data, a lot of different ways to look at the market in terms of all the energy sources. It covers coal, oil, natural gas, diesel, gasoline. There's a lot to look at there. And then, of course, every week there is this week in petroleum issued by the EIA as well. So if we look at crude oil, it gives you a synopsis of crude oil. Here's inventories. It has just finally entered the 5-year range as of the last week, just finally entered into the 5-year range. But it's not, the U.S. doesn't have a crude oil problem per se. It has a refining problem. So sure, oil prices are up, but gasoline prices as a percent are up even more because of the bottleneck in refining. I don't think that I'm the only one that would say this. I think almost anybody in the energy industry would say this as well. When I say the energy industry, in any carbon molecule-based energy, there is not a single reason on the horizon to invest a single dollar in any new capacity. You have governments around the world saying we are going to make you obsolete. And they've been called names for how long? Why would they spend a single penny on any kind of new capacity at all? Let's scroll back up here. Gasoline. This is interesting on the inventory. Notice that it's turned down. It was starting to come back up to the 5-year range, but it's turned down. Look how far out of the 5-year range it is, while oil supplies are entering into that 5-year band. This is a range of inventories over a 5-year period, and if you're in the middle of the range, that's about midway. Anything below the middle of the range is lower than the 5-year average. Anything above is higher. This is significantly lower than the 5-year range, and it just turned down. So you had oil, which turned up and entered the 5-year range. You have gasoline, which is turning down and going the other way. I'll leave those two links in the description box if you want to do deeper dives on the energy sector, if that is your thing. Plenty of resources available for free. You don't have to go buying a $3,000 report to get it done. All right, let's see if the CPI report is going to give us any good news on energy. I don't think so. Last report, from the last report, the weighting on energy as a whole is 8.255%. The price index from May 20, this is energy as a whole. I didn't break it down into its subcomponents, just the whole thing. May 21 to May 22, up 34.6% year over year. April to May, up 6.13%. Those are big numbers. Weighting's only 8%, but these are big numbers, right? Let's look at oil, CL, and we'll look at gasoline, RB. And over the month of May, you had a 12.9% increase in WTI and a 24.16% increase in gasoline. Notice that oil is only up 13%, but gas is up 24% because of that refinery bottleneck. That is over the month of May. The average price of oil in May was $109.25 per barrel and $3.7848, $3.78.42 per gallon during the month of May. What is appealing to some people, and I have heard this on Bloomberg, is that the CPI will show that energy prices have come down because they have dropped during the month of June. This is true. They have dropped during the month of June. During the month of June, oil has dropped 4.16%. This is from the end. This is the straight line here, and that is the ending price. So it's dropped 4.16%. And gasoline has dropped 7.2% over the month of June. But it's not the ending price. It's not just the ending price that matters. It's the average price over the course of the month. Oil over the month of June averaged 114.55 because it went from here to here. But for the first part of the month, it went higher before it started to give back. But I'm not measuring the price drop from somewhere in the middle of the month. I'm measuring it from the first to the end of the month, right? Averaged 114.55 per month. In other words, during the month of June, even though we saw oil prices drop, there still ended, the average for the month was still 4.85% above May. So month over month, oil contribution is 4.85% higher. Let's look at gasoline. Gasoline had the same issue here. The average price was $3.98.10 during June, even though it dropped, versus $3.78. In other words, gasoline was 5.2% higher in June than it was in May. So as far as the energy component for CPI, I don't see that it's going to help out at all. So we're not going to get any help from rent. We're not going to get any help from energy. I doubt we're going to get much help from owner's equivalent rent either. What about food? Food's a big problem. Because you need fertilizer to keep yields up. Well, what do you need to make fertilizer? You need natural gas. Forget about that in Europe. Or you need potassium nitrate. Well, where does potassium nitrate come from? You can get Canada, you can get Australia, you get China, but a lot of it was Russia. That's gone. So a lot of different countries, or a lot of different places that have crop production, had to make a choice. We either switch to crops which require less fertilizer, soybean is the common one to switch to, or we forego fertilizer, or we just pay the price. Now, if you pay the price, your output's got to be expensive. If you don't use fertilizer, your output will be cut in half. And you can't really get much potassium nitrate. So it's a big fertilizer problem because it's a big natural gas problem right now. So once we get into September, October, and the harvests come in and they're weak, and they will be weak, food prices are going to be elevated for a long period of time because it's the beginning of the supply chain for almost everything. You need the grains, which are ingredients to how many different products. You also need the grains because that's how you get meat. You got to give cows a form of protein, which is the grains, so that you can get a different form of protein, which is the meat. And the more expensive the proteins, the more expensive the meat. I don't think you're going to see a lot of help there. And I don't think, not that I don't think, I know interest rates can't fix that. Interest rates can't fix fertilizer. Interest rates can't fix energy, natural gas, oil, gasoline, refineries, exploration, production, investment. Interest rates can't fix any of that. Yet the FOMC had very strong language that we are committed. We can't let it get unanchored. It's going to be costly if we do. So I think they're going to say, look, here is CPI. Here is the stuff we can't fix. Let's destroy the stuff we can fix. And if we can get this stuff printing negative and this stuff positive, maybe the weighted average of the two might get us to around 2%. Because now everything is focused on this because they know they can't touch food. They know they can't touch energy. Wages are going to be tough. Housing is going to be tough. New cars are going to be tough. We've already talked about that. All of the car companies right now are producing at deep recessionary levels anyways, and they're selling every car they can make. There is no reason for those prices to come down. And these have big weightings. There's 8%. Energy, 8.2%. Housing, we've already seen, is 32%. There's 50%. Right there. Wages are an input to everything, and I haven't even counted the weighting on food. What are you going to do? Okay, let's look at an oil trade. I don't think it's worth getting exposure to oil prices directly through either futures contracts or an index because I don't see a lot of elevation above 120. Otherwise, it would have gotten there. I don't see a lot of give way under 100. Otherwise, it would have just gotten there and stayed there. So the producers are probably the best place to be. So you want to find low-cost producers. Why do all the homework? Warren Buffett is buying up shares of Occidental Petroleum. He bought some more on this pullback. I think he added like another 19 million shares. So it warrants a look. Let's have a look at Occidental. And is there any play that we're doing on here? He seems to really want it. He just keeps buying more and increasing his shares. So we have this, I drew a line at 55, which looks like near-term support, and a line at 50. We had the Ukrainian invasion, and it broke out above 50 and hasn't come back since. If we have recession fears, the price will continue to drop. But it must be global recessionary fears. It looks like that's sort of what is in the works, and especially if the U.S. enters a recession, it kind of going to take the rest of the world with it. Some parts of the world are already in recession. China would have been headed that way if it wasn't for the stimulus package and the stimulus that it's introducing. But I think that is just a matter of time before that doesn't work out for China. So I think China probably is heading, for them a recession is like 2%, 3% growth as opposed to 6, 7, 8, 9%. Yeah, I think they're heading probably sub 4% growth, which is going to be a problem, which makes me question my Aussie dollar position now that I start, when I get that conviction. I thought about it last week. I thought, I'm probably early to this trade. But I took a small position, but I'm probably early to this trade. Let's look at Occidental. And let's just think about different plays that we can think of. It's not much of a dividend overall, 13 cents. For a company that probably is not going to have very much capex, expansionary capex. Why its dividend isn't higher, I don't know. August, let's look at puts. 50 put, 55 put, $1.23 on the 50s, $2.50 on the 55s. Implied volatility sitting up close to 60%, so there's still good premium on this. The 50 puts put you way over here by August. I don't know that the energy markets are going to give back that much, that this is going to fall another 12%. Besides, Buffett bought on the way down. If it goes down further, I don't know that he would then turn around and say, oh, I was wrong, I'm going to sell. I mean, he might, but it just seems that with the aggression at which he's buying this now, he's got some other bigger plan for it. The 50 puts, if you're in the U.S., because I always give the margin requirements, but when I give the margin requirements, it's because I'm in Canada. And we have different levels of margin requirement. We start with 30% of the price of the stock first, whereas in the US you start with 20%. So you sell a $50 put, and if you are situated in the US, you have to post a minimum $500 margin plus whatever proceeds you get from selling the put, add to your margin, but you need $500 to get it done. If you do the 55, you need $645, but in Canada, and these are in Canadian dollars, if you sell the 50, you need 973 Canadian dollars in margin. If you sell the 55, you need 1,620. But 973 is what you need in margin. That can easily be satisfied with a bond. If you're holding Canadian bonds, you don't have to post cash. You can post a bond, and it's 123 US dollars, which is about 150, 160 bucks Canadian off 973, all the way to August 19th, I believe. Not bad ROI. If you are bullish, if you think, I think he might be, taking a position and taking it out, because if we look at who is moving closest to green oil, isn't that an oxymoron? By the way, I've heard it called oxymoron. I was listening to a philosophy professor on YouTube, and he kept calling it oxymoron instead of oxymoron. I've always pronounced it oxymoron. Is it oxymoron and I've just been pronouncing it wrong? Maybe it's the Canadian pronunciation, oxymoron. Anyways, green oil, that's an oxymoron or an oxymoron. If you're really educated and pompous, it's an oxymoron. It's an oxymoron. How's that? Why is it? Is because they're really big on carbon capture, and their goal is to be carbon neutral. So for every barrel of oil that they pull out of the ground, they want to take as much carbon out of the air as that barrel of oil emits. And I think it's like 20 pounds of CO2 for every gallon. So a barrel is 42 gallons, so they have to pull out 840 pounds of CO2 for every barrel that they pump. And they're very close to getting under that critical $200 a ton mark. And if they get to under $200 a ton, it adds 20 cents to a gallon. 20 cents to a gallon, and they are carbon neutral. And if they can get there, they may convince large parts of the world to say, hey, listen, you don't have to go to electric because we are carbon neutral. Our oil is carbon neutral. If you buy our oil, it is carbon neutral. Now that amount, 20 pounds per gallon, is from well to tank. That means from the time all the energy it takes to take it out of the ground and put it all the way into the vehicle. They're trying to get carbon neutral, and they're almost under that $200. It's direct air carbon capture. So they seem to be, from what I can read, they seem to be leading in that category. And if they can get some governments to say, yes, absolutely, that's carbon neutral, they're good. That they may be in a position to survive long term because of that. Maybe that's what he sees in it, right? Anyways, if you think that it's a potential takeover target, you can get a long synthetic position in, or use what's called a leveraged long synthetic. Here you want to give yourself some time, because it's not like he's going to do anything in the next couple of weeks. These things tend to take a bit of time. But he seems to be buying up shares right now, I think trying to get as close to the regulatory limit as possible so that he has them, and then go from there. Leverage long synthetic, you're going to sell the December $70 put, which means you're going to sell this put. It's already in the money by a certain amount, so you're going to get a good premium for that, and you're going to buy the $50 call, which is already in the money. This is what leverage is doing. You're using an in-the-money put to buy an in-the-money call. You're going to get a delta that is greater than 1. The delta on this put might be, let's say, 0.7, and the delta on the call might be 0.7. So you get a 1.4 delta out of a synthetic. It's the same as, having 140 shares but only paying for 100 of them. It's going to cost $45 to get that done, because this has a wicked smile on it right now. If you look at the volatility skew, it looks like this. It has got a wicked smile going on, because you got a whale like Buffett that starts chewing away at this fish in big bites. You get the rest of the market saying, I should buy some calls, and you get this kind of skew going on. So it is going to cost you some money to get done. Since you're buying the call, this has no margin other than what you pay. It's the put that's going to cause your margin. It's $1,400 because it's in the money, so it is a percentage. In the U.S., it's 20% of the strike. So you need $1,400 U.S.'s margin. In Canada, it's 30% of the strike. And then you have to convert that into Canadian dollars. So you'll need 2,719 to get that done. But you can't buy 140 shares of Occidental for $2,700, right? That's the thing. If you decide that, well, I don't need the 50, I don't need to spend that much, I can buy the $55 call instead. You actually get 255 as a credit. It becomes a credit play instead of a debit play. It's not going to cost you 45. You're going to get paid 255 to get it done. Your margin is unaffected because you're still selling the $70 put. It's just now you're going to get some money in, and some of that money can go towards satisfying your margin. Because you're paying significantly less for the call. The downside risk, of course, is this: if it drops below 55 or it drops below 50, you either have to roll forward your synthetic or you have to own it. But if you think, hey, listen, I don't think Buffett's day trading. And I don't think he just thought, hey, you know what? Let me go buy something. Occidental, I like the name. Let me buy that. I'm sure he's done his homework. So I don't know that you could do better than what he's already done. And if he's already decided that this is what he wants to do and this is where he is, there must be something there. You can always just say, look, I'm gonna walk in his shadow. The guy's done pretty good. I'll walk in his shadow. I'll see what happens. And he is a form of private equity. He does take companies private, and he has been very aggressive in buying this, but he's got some other companies that he's been aggressive buying up to the 50% point, owning half of them, and has never taken them completely private. So, I'll leave that to you, depending on what you like to do. If you're not quite sure, the $50 put with a short term is got some theta, $1.23 on it. You can, do something like that. If you are also bullish on the energy sector and bullish on oil companies, because they're going to have outsized revenues, outsized margins for a long period of time, because their cost structures are from yesterday, and their revenues are from today. Meaning that the oil price, you may be bullish on the sector. Why not travel with this guy? You might then say, no, that leverage long looks attractive. Just an idea that's out there, because I did notice on Bloomberg it was reported that he has bought more. Okay, time to shift our attention towards earnings, because that is going to be the theme for the next 2 weeks. So we got Monday, Tuesday, Wednesday, Thursday, Friday coming up, CPI on Wednesday. I don't know that it's really worth taking a lot of new positions ahead of Wednesday. And earnings, bank earnings, really Thursday and Friday. I think you have PepsiCo on Tuesday. You got nothing on Monday. You got PepsiCo on Tuesday. I think you got two more earnings reports on Wednesday morning. Nothing really significant, with Thursday and Friday being the big boys in banking. I don't know that it's worth taking a lot of aggressive positions before Wednesday. I don't know that it's worth doing much before Wednesday. Trading volumes last week dropped into Thursday and Friday. Even after the jobs report, Friday's volume was lower than Thursday's volume. I expect light volume on Monday and Tuesday as well, because I don't know that anybody, I know I wouldn't. If I have this looming in front of me on Wednesday, and I have the beginning of earnings season, which has a huge question mark on it, by the way. Everyone's saying, look, you've had the PE go down. That is always stage one in a recession. Stage two in a recession is EPS gets marked down. And then you take another leg down on wow, I'm not going to stand in front of this and stand in front of that. Who would, right? Let me see the number. I don't care if I miss the first 3 or 4% of a move, or the first 5% of a move. At least I have confirmation that whatever I do is in the right direction. But I'm not stepping in front of this. Here's what I see right now. When it comes to earnings, by the way, guidance will be everything. And as far as what we can expect from the Fed, whether 50 or 75, it's all in this report. This comes in without a decent reduction. Even if you get a slight reduction from last month, look at the language that was in the FOMC. They don't like this level at all. So if it comes in just a little bit, you're going 75. It's got to drop by, from 8.1, 8.3 headline down to 7, with the core down to 5.5. If it does that, I can see 50, but I still think they might, hammer 75 just to make the point. So if I had to handicap it right now, that'd be 90-10. That may change after the CPI report. This may disappear to 0, maybe, but that's where I'm sitting right now. As far as EPS, guidance is everything. They may beat on Q2. They may show growth year over year, because the economy has grown year over year. It's not like we've shrunk. The diffusion indexes, all the PMIs are dropping towards 50, but anything over 50 is still expansion. So the economy still has been expanding. It's going to be guidance. What they've done last quarter, great. What are you going to do going forward? They can kill it on the quarter and sell off hard because of guidance. Guidance will be everything. We are sitting at a forward PE of 16.19 now. Our forward PE is now moved past Q2. The forward PE is Q3 of 2022 to Q2 of 2023. The SPX is 38.99 closing on Friday. The forward EPS is 240. because we moved past Q2. Q2 has dropped off and Q2 of 2023 has come in. That's why the 240, yes, it's higher than the previous EPS numbers we've been using, but it is a full year out. We're adding a quarter that's 4 quarters ahead and getting rid of this one, 16.19. Trouble at 3,900. The index at the end of the week had trouble at 3,900, albeit on light volume. So I don't know that I want to read too much into that. The other thing that you can say is, well, the market moved up, but on light volume, so I don't know that I want to read too much into that either, but there is trouble at 39. You get past 39, you got 40.50 and 41.50 sitting in front of you. So I've been selling calls. I've been selling calls such that my break even is very close to 405. So I go up in the strikes until I find a premium that if I add to the strike, I get very close to 40.50. So if it does break out, I think you'll have trouble here. My best case scenario is I don't lose, but I don't make any money. So I'm playing it very light again until I see what we have going on here and what we have going on next week. So as of right now, I don't have a trade because there's 2 big unknowns coming up, and everything will depend on what happens there. If CPI comes in hot and guidance sucks, that's what's going to happen. Let's have a look at the volume. Okay, this is kind of hard to read. We're going to look at the consolidated tape A, tape B, and tape C over here. This is for New York Stock Exchange volume on the NYSE. And you're just going to eyeball it here, but you can see going back to in June what the volume is, 5.35684. As you continue up, look at these 2 dates. You drop during the week from 5 to 4.4 to 4 to 3.5. Look how light Friday was, 3.5. And if you look through previous volume, you don't even get to that low number. That's very low. For tape B, consolidated tape B, 1.6. Again, just look at the previous volumes. You don't get to 1.6. The 1.7, the 1.6, extremely low. Same with here, 4.6 down to 4.5. These are all over 5 for the most part. There's a 7 over 5. Let's look at SIBO. Daily volume reports. Here's your volume down here. So we don't have to go back that far. There's June 29th, 590, 661, 583, 667, 605, drops to 528 on Thursday, drops to 486 on Friday. You don't have a 486 anywhere back here. These numbers are all above 5. So that's a significant drop into the weekend. And let's look at NASDAQ. Where did I stick NASDAQ? Here it is. Here we have to go to Yahoo to find this, but here's your volume over here. You scroll down. This is way back in June. You could just eyeball the numbers: 5.67, 52, 51, 52, 94. Get down here, you're 4.6 and then 4.4, under 4.5. Whereas you're typically over 5. So you can see the drop off at SIBO, at NYSE, at NASDAQ. Really light volume. Had trouble at 39. Was that because it was light volume? Nobody had any conviction in front of the earnings week and CPI, especially after the minutes, especially after that language. The markets did go up over the course of the week, but again, on declining volume. Can we believe that? So there's just a lot of question marks right now. All right, let's revisit the Fed balance sheet. I should have done this earlier, but I just saw the tab now, and I thought, I'll stick it in there now. There was a puzzle last month in that the Fed was supposed to reduce the balance sheet by some $52.5 billion, 35 in treasuries and 17.5 in mortgage-backed securities. But over the course of the month, it didn't appear that they went in that direction. And somebody sent me an email saying there are 2 days out of every month where treasuries mature. They don't mature every single day. There are 2 specific days, and by using the 29th of last month to make the assessment, I missed the maturity by 1 day, that if you waited 1 more day, you would have seen that a certain amount wouldn't have rolled over. So May 25th, this was the state of the balance sheet, 8.392. If we go forward 1 week beginning of June, there's our beginning balance, 8.392 trillion. And then each week it tells you the change in the balance sheet. Well, over this week, nothing. But nothing matures. Nothing matures in that particular week. Up to the 15th, again, you're missing the maturity by one date here. Look at the increase, 10.8 trillion, going the wrong way. It went up, right? Sorry, 10.8 billion it increased by. If you go forward another week, it increased by another 1.2 billion, but most of that increase happened in the mortgage-backed securities. The notes and bonds did decrease. If we go back 1 week, this was at 933. Sorry, another week. This was 942. Notice that we dropped to 933, but your mortgage-backed securities increased. So this, again, another increase of 1.2. June 29th, you had a $19.5 billion decrease, but you got to go one, if they could have just done it for one more day, right? So you actually have to go to the next week. Look what happens the next week, $20.7 billion decrease. So they are moving in the right direction, albeit slow. They are moving in the right direction. My numbers show that that comes to about 28 billion decrease over June. So let's see. We'll see. Keep our eye on it. See what happens over July. All right, back to Lipper Alpha here and our two friends, Dylan and Alonzo. This week in earnings, we're starting 2022 Q2 year over year. The earnings are expected to be 5.7%. Excluding the energy sector, earnings are expected to be down 3%. 18 companies have reported earnings to date for the second quarter. 88.9 have reported earnings above analyst estimates. So they're already coming in above the estimate. You can see how earnings revisions have been brought down until near the end of June. Then they started to come up again. We don't need to look at the 18 that have reported. They're not significant enough names to make much of a difference. We'll scroll down here. This is page 10 of 24. Right in the middle, you'll get your EPS estimates. Forward 4 quarters, 240.83, which is what I had shown you on the previous screen. And you break it down by quarter in terms of growth rates for revenue and earnings. This is what we're expecting, 10.6% revenue increase year over year. Given that inflation is running 8.1%, that's about 2% real growth in revenues. Earnings up 5.7%, so on a real basis, earnings growth would be negative. Let's see who is reporting this week. Monday, nobody. And everybody's reporting before the open this week. PepsiCo on Tuesday, 8:30. That'll be interesting to watch. Estimate is 174, a year ago 172. If you want to get prepared for this one, what I would suggest is you go to PepsiCo's website, Investor Relations, and you listen to their last quarterly earnings conference call. Because the questions that were raised there and the guidance that was given there will help you prepare to what you would expect out of this one, as opposed to just waiting for one number. You'll be aware of what analysts are concerned about. So it might be worth spending an hour listening to the last conference call for the company that you're interested in. But PepsiCo is on the 12th, and then it starts to get interesting. Fastenal, it's the airlines, right? Delta, estimate 164, a year ago negative 107. Airline stocks have been flying high. You like that? The number of flights have decreased only because you can't get pilots. Every flight is booked, and there are no deals. So yeah, their revenues are going to look very good. And then we start getting into banks here. Look at Thursday, JP Morgan. That's the big boy. Expected 22% drop in EPS from 378 down to 294. They got their hands slapped a couple of times in the last quarter because of fines for doing something. So we'll see what happens there. It's their loan loss provisions that are going to be important to look at. Morgan Stanley and Charles Schwab are reporting as well. First Republic Bank. You have ConAgra up here. I think they'll do okay. And then Friday is another bank day. State Street, Bank of New York, BlackRock, Citigroup's another big one to watch. PNC Financial, United Health, US Bancorp, Wells Fargo as well. Look at the negative signs in front of all the banks that they're expected to report, year over year decreases in earnings. It's going to be their guidance that's extremely important. And if you want to get a tone for the market, there are ones that I would strongly recommend that you listen to the conference call. JP Morgan and Morgan Stanley, probably Citigroup, Wells Fargo. I'd probably be saying State Street and BlackRock as well are ones that I'd want to listen to their conference call. You don't have to be a shareholder in there. It's just you're going to hear the types of questions analysts are concerned about, and any kind of forward guidance, any kind of commentary on the state of the economy or what they're seeing in their books is going to be absolutely critical and set the tone, I think, going into the weekend. And that's it for the earnings calendar. It's light next week. The week after, I think you have something like 70 companies reporting, and then the week after that it goes into like 100 and something companies reporting. But that is the week during which we get the Fed decision as well, and I think the Fed decision is going to hinge very heavily, because it's the only real data point left that they're going to care about. It's going to hinge very heavily on Wednesday's CPI report. We're going to look at the economic week and calendar for the week ahead, but just to continue on that point, don't be a hero. There's no point being a hero Monday or Tuesday. In fact, probably the best thing you can do is nothing. Sit on your hands and don't get scared out of things or get coaxed into things by a market that decides to go up 40, 50 points on Monday and Tuesday. Especially if it's light volume. I think there's no point in trying to play the hero there. All right, one more screen before we get to the calendar here. Here are the challenges that I see for earnings and for guidance. The US dollar strength. You're going to have translation losses given the strength of the US dollar over the last quarter, up some 10%, and the continued strength. I don't know what can knock it off. Especially on Wednesday, if you get a hot CPI number, you're going to have even stronger dollar strength, which means you're going to have translation losses also spilling into the third quarter, because we are in the third quarter now as far as operations are concerned. But over Q2, you're going to have translation losses. That's going to weigh on earnings. Banks, what are they going to do with their loan loss provisions? I see them increasing. You have decreased mortgage activity. But a lot of banks have downsized their mortgage departments because of that. What is their forecast in that particular activity going forward? When do they see that market returning to normal? Because a lot of fees generated from that are now gone. The spread between the 3-month and the 5-year, 3-month and the 10-year has decreased. What is their forecast of their net interest margin on a going forward basis? That'll be important. And their guidance is going to be absolutely critical for overall economic health, because again, in the economy, in the financial sector, these guys are in a privileged position to see a whole bunch of activity going on. That if I had to listen to a central banker give me an economic projection or a commercial banker giving me an economic projection, I'll take the commercial banker any day, thank you. The industrials, important to watch here. Year over year PPI was 10.8% in May. CPI was 8.6%. That says that you don't have 100% throughput. Somebody somewhere has got to absorb it in their margins. Goods CPI as opposed to services-based CPI. Goods CPI 17.5% PPI. So industrials, I think, may have a bit of a problem, especially if they're not supply constraint industrials. Supply constraint ones can always increase their price. What to watch in this earnings season? I don't know so much that the EPS that they report or any non-GAAP measure that they report for Q2, I don't think any of that matters. That's last quarter. I don't think any of that matters. What you're going to be looking for are margins. What's going on with margins? And growth rates. What revenue growth rate do we have quarter over quarter, year over year? And operating income. Forget EPS. EPS is an accounting measure. I can always make my EPS by changing the way I recognize certain things. or classifying things as non-recurring and then giving you a non-GAAP measure, a non-GAAP EPS. But operating income is higher up in the income statement. Pay attention to that. Revenues and operating income growth. And above all, guidance. Not only guidance for EPS, but guidance for margins, especially margin businesses that are margin sensitive, especially for banks. Guidance for the net income margin. And guidance in terms of where they see revenues, where they're guiding revenue to. And usually it's a range, but you could take the mid part of the range and figure out what the growth rate of that is. So let's look at the economic calendar coming up. Although I don't know so much that anything beyond CPI or earnings really going to matter, but let's have a look. Okay, let's layer the economic calendar over the earnings calendar. Williams on Monday. Tuesday you have Barkin. Let's listen to what they have to say. Usually the transcript of their speech is available the moment they start talking, so you get the headline information right away. But where are they leaning towards, right? There it is right there, Wednesday, 8:30. Core inflation. The forecast is for 5.8 to be friendly to the market. You got to see this 5.5, 5.4, 5.3, but if you see it 5.7, I don't know that that's going to be too much. It's coming down way too slow would be the assessment. If it comes in higher than 5.8, take your chips off the table. Pull your bids and let the market do what it has to do. Let's keep going. Bank of Canada interest rate, 10 o'clock, expected 75 basis points. There it is there, from 1.5 to 2.25. If you have a hot core inflation and you have a Bank of Canada that moves 75, I don't know that it's going to help the Canadian dollar. The Canadian dollar is under pressure because of King US. And you need, I think, the only way we're going to get a Canadian dollar rally right now, it's got a trade surplus, it's raising interest rate, it's got a central banker that's more hawkish, but you can't beat King dollar right now. You need the US dollar to weaken if we want the Canadian to rally, so let's see what happens here. That's going to be an interesting day altogether. If you're into the oil market, you have all of the inventory reports, 10:30 every Wednesday. The beige book, let's see, what else do we have here? PPI on July 14th. We'll see what that comes in at. That speaks more towards margins, but I still think earnings and CPI are going to overshadow that. You have another Fed speak at 11 going into Friday. Retail sales, I don't know, again, that's going to be that important, but health of the consumer, we'll see what that looks like. You have another Fed speak over here. Michigan consumer sentiment, we're under 50. The forecast, we're at 50, so previous was 50, 49.8. We're under 50. That's, the Fed has signaled that it notices that. So I guess we got to notice it as well. And that's about it. Let's just go to the last 7 days here. Let's scroll down to Friday. Consumer credit. The forecast was for 31.9 billion, came in at 22.35. Still an expansion of consumer credit by 22 billion, but significantly lower than the 31 billion. A third lower than the 31 billion that was expected. So that may be the beginning of something. And that's it. Beyond CPI and earnings, I think those are the two big themes going into the week. And let's meet here again next Sunday and do a damage report.